Federal Reserve has canceled the recession in the US, the Bank of Canada almost didn't increase interest rates in July, and the majority of economists are now predicting that the Bank of Canada is finished increasing interest rates. But before I get into all the details, if you're new to this channel, go ahead, hit the subscribe button and hit the like button so more people like you can see this video. And if you know me from my other channel, make sure you hit the subscribe button on this one as well, because this is now where Canadian finance and real estate news videos are going to live. Okay, so lots of news in the interest rate world this week. The Federal Reserve in the US has canceled the recession. Their economists are no longer predicting that the US economy will fall into a recession, citing greater than expected growth in the economy. Then the Bank of Canada went on to release their minute notes from July and almost didn't get to the point of increasing interest rates. And then they also released their market participants survey, which is really interesting. I think the results will surprise you, especially with respect to where market participants see interest rates going. So I'm going to jump into the news and show you all the details here. Let's start first with the Fed in the US. Powell says Fed staff is no longer forecasting a recession. Staff economists dropped downturn forecasts that they debuted in March. Fed chair cites recent resilience in the economy for the upgrade. So what this suggests is that the resilience in the US economy is suggesting that there may not be a need for a recession. So in other words, the soft landing that central bankers crave so much may in fact be a reality in the US. And this change in forecast absolutely wreaked havoc on the bond market this week, with interest rates jumping up, then down, then up, then down, then up, then down. It was an absolute roller coaster. Some lenders have even increased interest rates across the board on uninsured mortgages, which is something that we have not seen previously. That may mean that certain banks and investors are trying to pull back on the amount of mortgages that they fund. Now, in addition to the change in language from the Fed, which indicates that there may not be any further interest rate increases, although they didn't take that completely off the table, the Bank of Canada released their deliberations, and it turns out that they deliberated delaying rate hikes amid inflation concerns. Now, this is really interesting because I had to pull this from Fox News. I did see it on some Canadian media sites, but the traces of that have pretty much disappeared, which tells me one of two things. Either it wasn't a real good news story, or perhaps there was some fear with respect to Canadians thinking that the worst of it was over. But what's important to note here is that the reason why they did, in fact, increase interest rates is because the consensus was that the cost of delaying action was larger than the benefit of waiting. So in other words, they saw increasing interest rates and getting it wrong as a better alternative than doing nothing and getting it wrong. And that goes back to their desire to make sure that inflation is absolutely crushed. But here's where it gets even more interesting this week. They also released their market participant survey. So this is a survey of 30 market participants, generally big businesses with economists, and it gives the Bank of Canada an indication of what the market sentiment is around interest rates. Now, what's really interesting in this report is the fact that most market participants see the 5% that we have already reached as the ceiling to where rates will go. And when you look at the forecast here, pretty much the entirety of market participants are predicting that interest rates are going to remain at 5% until the end of the year. Now, there may be some outliers here. There may have been some who said they think interest rates are going to go down. There may have been some who think interest rates are going to go up. But the large majority are saying that 5% is going to be the ceiling. And as you look further down the road, there also seems to be a consensus that by the end of the year next year, interest rates are going to be significantly lower than they are right now. Now, typically, when you look at news sources, that would be where the story ends. But if you dig deeper and you look at the actual data that they have released, there's one more key piece to this data. And that is the question with respect to how would you describe the balance of risk around your forecast for the Bank of Canada's policy interest rate? Do you think it would be skewed to a higher path, a lower path, or are the risks broadly balanced? And the important thing to note here is that 57.7% of respondents say that their forecast is skewed to a higher path. But again, if you look at the next question, which is at what level do you expect the policy rate to peak, pretty much everyone is saying 5%, which is exactly where we are right now. And when asked what they believe the long-term neutral rate would be, everyone is saying around 2.5 to 3%, which means in the long term, all else being equal, we should start to see interest rates come down at some point, albeit not in the near future. And this all leads to a really interesting article from the New Yorker that asked the question, why did economic forecasters get their recession call wrong? Not only has the economy outperformed predictions, but it's growing at a faster rate than experts think is sustainable in the long run. And I'll save you the detailed explanation and let you find this article for yourself if you want to dig into it. But the gist of this is that forecasters tend to get their predictions wrong. The reason why is because economies are incredibly complex. And the biggest issue with respect to forecasting the US and the Canadian economy is the fact that the Biden and the Trudeau administration's COVID relief measures were significantly more successful and sustainable than many thought possible. And it now seems that we're going to come out of this pandemic situation and the aftermath in a pretty reasonable place. But I found one part of this article really interesting, and that was the last paragraph. The author writes, as a worrywart, I can always find things. The Fed could still tank the economy by keeping rates too high for too long. The renewed bubble in the technology stocks driven by optimism about AI could end in a stock market crash. There could be another banking crisis or something out of the blue, such as a conflict in the Middle East that creates another run-up in energy prices. I could also point to the side of economic forecasters getting more optimistic, but that would be mean. For now, let's just celebrate the fact that their predictions turned out to be wrong. Now, this leads to a really interesting conversation about economics and news media and what you should be doing when you're trying to assess what's going on in an economy. Because the tendency is for people to look to the news articles and the headlines that match their personal philosophies. And this is getting even worse as time goes on, especially politically. But what you should be doing when you're looking at what's going on in an economy and trying to make financial decisions based on forecasts is you should be trying to develop your own opinion with respect to what's going on. Then what you should be doing is looking at your worst case scenarios, your best case scenarios, and then making your financial decisions based on that. For example, if you're looking at a fixed versus a variable rate mortgage right now, the first thing you need to look at is your risk tolerance. If you have a very high risk tolerance, then choosing a variable rate may not be a big deal because you may be willing to deal with higher interest rates and significantly higher payments down the road. But if you've got a low risk tolerance, you may be a fixed rate borrower regardless of what the Bank of Canada's poll from economists is saying with respect to interest rates. So what you need to do is look at a large base of perspectives, and then from there, try to figure out what the worst case scenario is and if you can handle it. Don't just pick one guy like me or a specific journalist or a specific economist and go, I like what he says, so I'm going to follow him blindly. Develop your own views and then make sure that every financial decision you make is aligned with your own risk tolerance. Oh, and if you want to see more about what's going on with interest rates in the Canadian real estate world, make sure you check out this video right here.